Okay, this is chapter 3, part 4, and we're just finishing up with depreciation. Depreciation is a deferral. You're purchasing an asset, and then you're going to defer the expense of that asset until, to future periods. And so here is the journal entry. That's where we finished off. Those two accounts go hand in hand. Depreciation expense will be debited. Accumulated depreciation will be credited. Now, what's accumulated depreciation? That is known as a contra asset account. All right, a contra asset account. It means that it will offset against an asset account on the balance sheet. And I'll show you that. I'll show what it looks like on the balance sheet. And again, it's in your text. There are other types of contra accounts. Now, a contra account, this is the definition out of your book, has increases, decreases, and normal balances opposite to the account to which they relate. So this one is a contra asset account. If assets normally have a debit balance, then this accumulated depreciation account will normally have a credit balance. Let's continue. All right, let's look at the T account. So there's my journal entry, depreciation expense, and then I credit this contra asset account, accumulated depreciation. So there, the T account, I'm posting this to the general ledger. All right, the original the book of entry is the general journal, and then we'll post it to the general ledger. That was chapter 2. All right, so we have this equipment. It's an asset. So there's the debit of 62,000. Then I'm recording this December 31st entry, this adjusting entry, and there's depreciation expense I'm debiting for 12,000, and there's accumulated depreciation which I'm crediting for 12,000. Again, accumulated depreciation is going to show up on the balance sheet. It's a contra asset account. Let's look at that. This is just a partial view of a balance sheet for this company. And there's the assets and, cash. You're going to list your assets by order of liquidity. So cash is the most liquid, so that'll be listed first. And then we're just going to go down. Now, you'll list your equipment. There's the 62,000. And then we're going to put down less accumulated depreciation of 12,000. So the net book value of our asset is 50,000. Now, what good is this? Why do I want this? As the reader of the financial statements, I can look at this now and say, okay, the equipment originally cost 6,000, but it's only been depreciated for 12,000 dollars worth. So it's got to have more useful life out of this equipment. It's relatively new. The book value is 50,000, so it's relatively new, and so this company has future years in generating revenue with this one piece of equipment. All right, so that's why we list it that way. We could have just reduced our equipment account, but then you're not providing all the information to your readers, to whoever you're going to give your financial statements to. All right, let's look at the revenue side. So we have our unearned deferred revenues, and remember, that's a liability account. The example they give us here is that cash is received in advance of providing products or services. That's the definition for unearned deferred revenue. But the example that they're giving us here is with a sporting team. So customers, fans, sorry, I'm an accountant, they're going to buy their season tickets for all the basketball games, but they're going to purchase it now. So we're going to have this unearned deferred revenue that we're going to record, and that'll be the liability. And then, so that's what they're showing here in the T account as the unadjusted balance. And then, well, anyway, in that T account, but I could probably, I wonder if I can escape, go back. I don't see the little thing. All right, let me just continue. But the adjusting entry would have been that the other items on that T account where you're going to reduce that liability, but then you'll record the revenue. All right, so here's the example. On October 1st, Ox University sold 1,000 season tickets to its 20 home basketball games for $100 each. Ox University makes the following entry. All right, so let's record the entry on October 1st where we're receiving the cash, but we haven't earned the revenue. Right, so on October 1st, we've got cash of 100,000, and I have this unearned revenue, a liability of 100,000. Because what if a customer comes, one of the fans says, "Oh, I need a refund. You sold me too many tickets, or I meant to purchase these amount, whatever." We give them a refund. So it's a liability until that game actually occurs. You may have to owe that money back to the fan. So you're going to record this liability. So cash is received, but we haven't earned the revenue yet. So let me get this through. A revenue not earned cannot be shown on your income statement even if the cash is collected. So we collected cash, but did we earn the revenue? We haven't. So we cannot show the revenue as being earned on our income statement. So that's why we set it up on our balance sheet as a liability account, and that's the unearned revenue account, or it could be entitled deferred revenue. All right, so on December 31st, now let's see what our adjusting entry will be, because we have to record some revenue at the end of our fiscal year. And December 31st, so obviously they're a calendar business. So Ox University has played 10 of its regular home games, winning 2 and losing 8. Do we really care how many they won or lost? It sounds like my college team. I think they only won 2. Sorry. But anyway, so on December 31st, we want to record the revenue for those 10 games that have actually occurred, because we've earned that revenue. All right, so I'm going to record basketball revenue. I'll credit it for 50,000. That's half. I think it was the original example said 20 home games. So we've earned half of the revenue that we took in. So the original revenue we took in was 100,000. So we'll just recognize the 10 games out of the 20. And so we have basketball revenue of 50,000. And then we're going to reduce that liability account, because those fans cannot come back to us and say, "Hey, I want my money back." So here on the T account, you have unearned revenue. That's a liability. The original entry was October 1st, 100,000. And then we're going to debit it. We're going to reduce it by the 50,000. So now we still have unearned revenue. Our balance on our balance sheet for unearned revenue is 50,000. But meanwhile, on our income statement, we have basketball revenue as of December 31st of 50,000. All right, let's see. What else do we have? Okay, now we're going into accrued revenues, or accruals. Accrued revenues and accrued expenses. So here, revenues earned in a period that are both unrecorded and not yet received. So we've earned the revenues, we just haven't gotten our money yet. So here's an example of an account or a tax preparer. Yes, I've completed your tax return, but have not had time to bill you yet. And the entry that we're going to make, and this is the adjusting entry, we're going to record an asset, an account receivable the person owes us, and we'll record the revenue. So we haven't received the cash with accruals. We don't receive the cash yet. All right, so here's the example. Smith & Jones CPA had 31,200 of work completed but not yet billed to clients. Let's make the adjusting entry necessary on December 31st, the end of the company's fiscal year. All right, so I need to record the fact that I've done this work. These people owe me, so I want to record that this receivable. So I have accounts receivable of 31,200, and I record the revenue of 31,200. Now, they're not going to pay me until 2008, but I don't care whether they haven't paid me yet. They owe me that money. As of December 31st, I've earned that revenue, so we're going to record it. Remember, a revenue not earned cannot be shown even if collected. All right, so, but here, the revenue is earned. We just haven't received the cash yet, so we're going to record that revenue. All right, accrued expenses. So in this case, costs are incurred in a period that are both unpaid and unrecorded. All right, we're about one half done with this job and want to be paid for our work. So we're going to bill them. We'll bill the customer. We've incurred that expense. but um, we I'm thinking of it as a seller. I should be thinking of it as a buyer. But as a buyer, we've incurred this expense. So I want to record the expense, but I haven't paid it yet. All right. I need to stop here, so we'll continue in the next part with this slide.